Hello, this is Chuck Carnevale, and with this article, I'm wishing a happy 8th birthday to the second longest and fourth strongest bull market for the S&P 500 in modern history. However, my real message is, what about its current valuation? Has the market now become dangerously overvalued relative to intrinsic value and historical norms? In order to illustrate the relative valuation of the S&P 500, I'm going to utilize the earnings and price correlated fast graphs, fundamentals analyzer software tool, looking at the S&P 500 since 1998. What I have on the screen currently is simply earnings per share multiplied by a 15 PE ratio. In other words, the orange line on this graph represents a PE ratio of 15 for the S&P 500, which I consider fair value or reasonable fair value for the market, mainly because it also would represent an earnings yield of 6.6%. However, next I'm going to add monthly closing prices onto the graph, and what this does, it allows us to evaluate some really interesting historical facts here about the S&P 500 and its valuation and what has resulted as a result. For example, if you look back into what was often referred to as the irrational exuberant period, which ended in the fall of 2000, we see excessive overvaluation of the market with PEs up in the high 20s, and that of course resulted into a very strong drop in the market as we came into the recession of 2001, which also saw a break in earnings. But as I mentioned in the article, coming out of the 2001 recession, we saw several years of very strong earnings growth. And then, of course, we came into the Great Recession, when I'm going to point out that valuations were relatively high as in reference to this 15 PE ratio, and then the S&P became actually significantly undervalued by the end of February 2007, which, as I indicated in the article, marked kind of the birth of this 8-year bull market that we've currently gone through. And then I want you to notice that you see valuation staying within a reasonable correlation to that 15 PE, and then since the fall of 2013, valuations have become very high. Next, I'm going to add the normal PE calculation for this long-term time frame. And so what we're really seeing here is a range of valuation. This blue line represents a PE ratio of 18.6, or a normal PE ratio of 18.6. And as you can see, there was an extreme outlier here, as I previously mentioned, in the irrational exuberant period. Then there was a period where the market has stayed within the orange and blue line for the most part during this time, and now we see that even relative to this relatively high 18.6 normal PE ratio, the market is currently trading at a blended PE ratio of 19.9 or above that current valuation. I also want to point out forecasting. Analysts are forecasting almost an 11% earnings growth rate for this year and a 12% growth rate for 2018, but I'll talk more about that later. Next, I want to add dividends and the dividend payout ratio, which is the area below this white line, and then again express dividends after they've been paid out of the S&P 500. So what you're seeing here from this long-term perspective is a pretty clear picture of valuation and fair valuation relative to the market. Coming out of the Great Recession was a great time to be an investor in stocks, and it was really rational in my view up to about 2013. But as I think this graph clearly illustrates, valuations have become extended. But now I want to take advantage of the dynamic nature of fast graphs and start shortening some time frames here to see how this perspective changes. If I drop this down to a 15-year graph, which starts in 2004, or well after the first recession on the graph, we see a normal valuation closer to 16.6 for the market during this time frame. Again, price relates very closely to the orange and the blue line here, and it's become outside of that corridor, if you will, as we came into 2016, and it continues to remain that now. I shorten the time frame a little bit more, and we see that the normal PE ratio has fallen a little bit more. I bring it down to 6 years, and we see that during this period of time, we do see, again, a slightly higher normal PE ratio over this time frame. But even at this level, the current PE ratio looks high for the S&P 500. But now I'd like to focus a little bit on forecasting, because this is an often debated subject. How good are analysts at forecasting the S&P 500's earnings, and how closely do the actual numbers come to what the analysts are forecasting? In order to get a reasonable perspective on that, I'm going to look at how accurate analysts have been when they were making a earnings forecast for the S&P 500 1 year in advance. And then next I'll show you what they looked like 2 years in advance, which is about as far out as I would want to go for forecasting the S&P. Now I want you to notice that coming out of the recession of 2001, the analysts missed earnings excessively by almost 24%. They were forecasting $61 in earnings. The S&P actually earned $41.12. And similarly, during the Great Recession, as we entered the Great Recession, we saw a similar error. We saw a forecast of $91. The recession hit, earnings came in at $72.81, and then for 2009, they were forecasting $96.75, and earnings came in at $60. That's a 25 and 60% overestimation, respectively. But then since the Great Recession ended, I want you to notice that the analysts have been reasonably accurate. In fact, the S&P actually exceeded estimates for 3 years. But then in 2015, and then once again in 2016, the earnings numbers came in slightly lower. They missed it by 2% in 2015 and by 9% in 2016. And then very quickly, let's look at how good the analysts have been when they were making a forecast 2 years in advance. And we see a very similar pattern. Misses as we were facing coming out of the recession of 2001, and then we again saw misses in 2009 and 10. But then once again we see reasonable accuracy as we've come out of the recession, as earnings improved dramatically. But we also saw that the 2015 estimate that was made in 2013 and the 2016 estimate that was made in 2014 both were slightly under what the analysts were forecasting. So when you look at the overall record, analysts have been reasonably accurate on forecasting the S&P 500, but they have missed estimates twice. And I think the real story here that I want to tell is the biggest danger of an earnings miss on the S&P 500 of any magnitude tends to come during periods when we are entering a recession. And we've had a long run now where we haven't had a recession, as we illustrated earlier, but we've also, more importantly, had this long bull market, second longest and fourth strongest in history. Now, I'd like to end this video by just taking some quick calculations about what could the potential be, assuming normalcy. So I'm going to start by looking at current multiple and assuming that these estimates are reasonably accurate. What would happen if the S&P sort of reverted to the mean and fell to a 15 PE ratio by the end of 2018? That would mean a minus 7.5% total negative rate of return, or a 1.7% annualized over this just slightly less than 2-year period. In contrast, if the S&P 500 continued to move to that 18.6 long-term normal PE, you could see a 10% rate of return. But once again, I want to remind you, if we shorten the time frames, that normal PE has been lower over recent times. So once again, we see a opportunity here to see that minus 7.5% if it reverted to the 15. And if it actually reverted to the 16 PE, we see a very low rate of return annualized at 2.5%, thanks more to dividends than almost anything else. Very little growth in the S&P over this time frame. So to kind of conclude my remarks here, I do consider the S&P 500 to have entered what I would call a very high valuation range. Doesn't mean the S&P is going to fall. The bull run could run for several more years. But my real purpose here is simply to illustrate that stock prices, as it relates to the general market, are not cheap like they were back in 2011, 9, 10, etc. We now are in a period where caution is in order. This has been Chuck Carnevale saying thanks for listening.